Hi, and welcome to Palm Springs Life Market Watch. I'm Tally Fantini with Palm Springs Life. Today's corporate sponsors of Market Watch are Sunrise Company, Andalusia Country Club, Toscana Country Club, Franklin Loan Center, Palm Springs Regional Association of Realtors, and California Desert Association of Realtors. Today's Market Watch topic is Sales Are Up, Will It Last? To discuss this very important topic, we've got three incredible speakers. To begin, Mike McDonald with Market Watch LLC, who will discuss the challenges of low inventory and prices and housing metrics here versus other markets, as well as where the buyer is coming from and why. Then we have Walter Neal with Franklin Loan Center, who will discuss the challenges of COVID-19 on the CIA mortgage test, as well as updates on forbearance. And lastly, we have Brady Sandall with the Brady Sandall Group at Keller Williams Luxury Homes to discuss the market of the moment and how to master it. Without further ado, we'll go ahead and get started. But first, I want to let you know you can submit questions right up in the left corner in the chat area. If we don't get to your questions today, we'll make sure to submit your questions to our speakers, and the responses will come in the recap of this virtual event. Without further ado, let's go ahead and get started with Mike McDonald. Mike?
Thank you, Tolly. Good morning, ladies and gentlemen. This presentation will show you something both unexpected and truly amazing. That in the midst of a national pandemic, we also suddenly appear to be in one of the strongest housing markets in the last 15 years. It's almost contradictory, but it seems to be true. I'll show you all the facts that point to this, and most important, we'll discuss whether it's temporary or whether this will continue for a while. So on this first slide, I'm going to show you sales. This is sales of Los Angeles County. This is 1 year. I'm going to spend a little bit of time explaining this chart to get you familiar with it, because the next four charts are identical to it, but for other regions. So if we spend time here, it's going to add dividends. This is 1 year of time. This goes back to July 31st, 2019. Each one of these is a year. This is a daily plot of average sales in Los Angeles County. Over here, it's 50 sales a day, 100 sales a day, 150, 200. 250, and you'll notice that we have two curves. Also here, this is the spot where Governor Newsom defined the quarantine, which was March 19th. That occurred back here. It's quite a ways ago in time. A lot has happened since then, but I want to point out here, we've got two curves. This lighter colored curve is closed sales. A year ago, on July 31st, closed sales was 157 units. Currently it's 140, so it's still lower on closed sales, but this other curve is a moving average of daily pending sales. A year ago it was 165, currently it's 194. So currently pending sales are ahead of year ago pending sales before the coronavirus was even started. Now I want to show you something about this pending sales and why this is so valuable at this period of time. Notice that these two curves are not in synchronization. They're kind of what they call out of phase with one another. That's because the average escrow period of time in the LA County is 35 days. So you would expect a pending sale on average to become a closed sale after about 35 days. So if we take this dark blue line and move it forward in time, 35 days, we're going to see something interesting. I'm going to do it for you and then do it again so you see it, so you fully understand what we're doing here. I'm going to move this curve forward here 35 days. Now watch the screen. See that? Now what happened is now they're in synchronization as you would expect. Pending sales are forecasting where closed sales will be in about 35 days. For example, this point over here is September. Okay, we're all the way into September. This means that currently, closed sales are 140 units a day in LA County. Pending sales is forecasting that will rise another 50 units. So pending sales are forecasting a continual increase in the current sales rates that we've been getting since this recovery has been in effect after this quarantine fall off. We've been really in a 3-month expansion of sales And that's becoming very acute, actually, in the valley. So I'm going to show you now these same curves. I'm not going to go through the movement back and forth. Now that you understand pending and closed sales, I'm just going to show you this curve, but for the Coachella Valley. And that's this next curve. Pending sales of single-family residences are 56% above last year's levels, okay? Forecasting even higher closed sales. This is closed and pending sales. You can see the close match here. Here, though, instead of 35 days, it's 20 days for detached homes. And you can see the close correlation between pending sales and closed sales in the valley. It means that pending sales are 56% ahead of where they were last year at this time before the coronavirus hit. That's it's hard to believe, but it is. All right. And that's one of the patterns that we've been noting here. Now I'll show you the next curve, which is for condos. Condos are 42% above last year's levels. So this pattern of higher sales by quite a wide margin is occurring in both home types throughout the whole valley. Okay. Now let's take a look at this city by city. This is, again, the total values for the region. What does it look like if you look at the city ones? And I'm going to show you a table of cities here. Cathedral City, Coachella, Desert Hot Springs, Indian Wells, Indio, La Quinta, Palm Desert, Palm Springs, and Rancho Mirage. This are single family residences. These are the tables for condos and total for both these two. So for all homes. This is July 31st, just a couple of days ago, a year ago level. These are average weekly pending sales, pending and active under contract. You have to include those too, because those are effectively pending sales too. So let's take a look at these. On average, for example, on a weekly basis, Cathedral City has been having 13.8 pending sales a week. A year ago, it was 10.8. So we're with Cathedral City, we're 27%, almost 28 ahead of a year ago. But I want to bring your attention to a couple of cities. It's really remarkable. Indian Wells, currently pending sales of single family residences in Indian Wells is 130% above last year. La Quinta, 86%. Palm Springs, which continues to be the darling city of the region, up 120%, 27% over a year ago. All right. That's truly amazing considering the situation we're in. Over here under total home sales, it's 105%, La Quinta, 84%, and Indian Wells about 100%, 105. So what we have here is something that one would never expect to have happened, but it is happening. Again, we'll discuss whether it has legs or this is a temporary snapback after that fall off in sales we had after the quarantine. That's the critical question. And we'll answer that or give our opinion on it near the end. Now let's go to something else. This is for sales. Let's take a look at inventory. Now here we have total valley inventory going back to 2010. So we have 10 years of time. Each one of these is the monthly inventory. Notice the seasonal pattern in inventory in the valley. It's very, very seasonal. It's almost like a clock, okay? Here, this is represents August 1st, each line here, August 1st of each year, going back 10, 11 years. And notice that the bottom in inventory always seems to occur in September. Okay, here's September, here's August 1st, September 1st. And so you can see the seasonal pattern, and invariably, the peak in inventory occurs in March. Okay, so this pattern is very well defined. And because of that pattern, you can't compare inventory in January with inventory in July. You have to compare inventory every year against previous years on that same date. Okay, and that's what we've done here. Current inventory, believe it or not, in the Coachella Valley, all 9 cities, is 2,050 units. That's both condominiums and single family residences. Prior years, last year it was 2,720. So already you've got about a 30% decline here. 2735, 3346. The highest level was back about 4,500 back here on August 1st. So inventory is, and we have a 4.5-year decline here. This trend of declining inventory has been in effect now for 4.5 years and is really the defining feature of the housing market throughout California. Now, this is very important because this represents the supply of homes. Remember, supply and demand, because we're going to be talking about price, what this means price-wise going forward, which is really the important aspect of what's going on here. What it forecasts for price, what we think is going to happen over the next year and a half. Okay, so let's go to the next slide, which is inventory. Now, this inventory that we just looked at here, remember, is a composite of condominiums and detached homes. But remember also, the Valley has a very unique housing market. It's really a combination of local buyers who live in the Valley, who own homes in the Valley, or retirees who come out and retire out in the Valley. We call those the local homeowners, the local market, the owner-occupied homes, versus the second homeowner, people who live in Illinois or Texas, or Oregon or Washington, who come here for maybe 3 or 4 months out of the year to live and get away from the cold weather. It's important to know about 40% of the market, 35 to 40% is this remote owner component to our housing market. It's very important. Other regions like Los Angeles, maybe it's only 10%, but out here in the Valley, it's one of the major components. So we're going to take a look at kind of how this inventory breaks down, because it's important to keep both markets functioning. We want to have both the remote owner market and the local market performing together well. In other words, we don't want any dislocations in one because it can override and affect the other. So how does the inventory look when we look at the various components of what make it up? Here it is, excuse me, there. This represents the percent of the listings going back 2016 that were from remote owners. See over here, these are people who have second homes or rental property out here, who really don't maybe live out here, but come temporarily or rent homes out here. Normally speaking, it's around, maybe 47%, excuse me, 47% of all listings are remote owners. And we got kind of worried until we did the latest calculations. We thought because of the coronavirus problem that there could be kind of a dislocation going on. Maybe more remote owners are selling their property than normal, but it turns out there isn't any. The latest reading is 47.8%. The integrity of the market, of the remote owner market, is fine. Now, we think that's very important. That represents, again, about 40% of the market, maybe close to 50% of the market out here. That is holding together very, very well in the face of this coronavirus pandemic, okay? That's important. The next component is what percent of the listings are attached homes. Normally, it's around 35–40% of the listings are from attached homes. We were wondering if that has changed a little bit, and it is slightly. It's increasing. In other words, the percentage of homes that are attached, which is normally around 30%, you can see historically around 30%, is moved up over the last 3 months to 36.8%. We're not sure exactly why at this point. It doesn't seem like it's out of line. We'll have to see if this progresses or settles back a little bit. But for this point in time, everything in the listing market looks good. In other words, there's no internal dislocations that appear to be forming at all. Now let's go to another very important metric, which really combines sales and inventory, which is called the month of sales ratio. The month of sales ratio is the best indicator of the balance of supply and demand. It's how many months you take inventory and divide it by the sales rate to come up with how many months it would take at the current sales rate to liquidate the entire inventory. And again, this is very seasonal. We have the past history ratios, for example, 3.4 months. This is months, 3.2, 4.6, 5.3. It's now down to under 3, 2.7. That's the lowest ratio, meaning that demand is exceeding supply by the greatest factor, at least over the last 10 years. Okay, that is the keynote or the defining factor of this current market. And now let's go to basically prices. What's happening price-wise? Valley prices, we know the supply and demand is very positive for prices. Valley prices remain strong. This again is a table of current prices, year-ago levels, and March 19th, the start of the quarantine levels for detached homes, the same for condominiums, each by city. The region shows throughout the region, detached homes are up year over year 10% throughout the region. That's the average of all the 9 homes. Over here for condominiums, prices are ahead year over year 5.8%. Certain cities, again, require note. For example, Cathedral City is ahead by 11.9%. Coachella, the city of Coachella, 26%. La Quinta, 10.3%. Palm Springs, again, the darling of the area, up 16.2% for detached homes. Very strong on its price motion. Over here, condominiums, 11.6%. So price-wise, we're starting to see something we haven't seen for quite a while. Record low inventory, record low mortgage interest rates, plus rising sales are beginning to generate some bidding wars. And I think Brady and Wall are going to talk a little bit more about that besides what I'm mentioning on it. I'm giving kind of some numbers on it. So let me get to the summary of my presentation, okay? Let's go over the main points. In the middle of a national pandemic, we have the hottest housing market in over 13 years. Pending sales for single-family residences are 56% above year-ago levels. Condominiums are 42% above. Total Valley inventory at 2,050 units is lowest in over 20 years. No inventory imbalances. Ratios of inventory by owner type and housing type remain in normal regions, which is very good. The housing market has not been distorted by this coronavirus, which is important. Gains in Valley home prices, especially for detached homes, are currently double digit. High double digits, actually like 15, 16% in certain cities. The forces of demand over supply, greatest in recent history, pointing to further price gains. Now the question, the most important question, I think, is this just a post-quarantine snapback or will it last? Nobody really knows. We have some opinions. I have an opinion. I personally believe, after following markets for many, many years, 40 years actually, this has a very unique characteristic. In other words, that contraction in inventory is a 4.5-year phenomenon, intensified somewhat by the coronavirus. I think that because of the coronavirus seems to be causing people to want to get out of the city areas, high congestion areas, and move to a place like the Coachella Valley is fueling a lot of the demand we have here. So I think that this is not just a temporary snapback, that it's going to continue. And if it does, the pressure on housing prices is going to intensify. It would not be unusual, okay, for a situation like this to generate 10 to 20% price gains over a year and a half. We saw it other periods of time when you had many, many bidders coming into the market. It would not surprise me to see that possibly happen again. And that, by the way, would help solve some of the inventory problem, okay, that we have. Now, the question that some people ask is this a comparison to the housing bubble of 2004 to 2006? No, there's absolutely no comparison between 2004 market back then when prices started to go up and they had bidding wars. That market was very unusual. It was driven by an overuse of variable rate mortgages. And when interest rates started going back, we had a reset problem. The only solution at the time was foreclosures. Currently, we have another solution, which is much better, called forbearance. Walt will talk a lot about that. That's rescuing the situation. The idea is to keep people in their homes. Everybody's in a difficult situation right now, and they're doing the right thing. Let these people stay in their home, work out an arrangement of payment so that there's not, people don't have to sell their home, and we can get this thing under control. They're doing the right thing. Again, that's going to help the market also. So that's the summary of my presentation. Hopefully gave you some insights and some maybe different viewpoints on that. I'd like to now introduce Walter Neal, president of Franklin Loanstetter. He's going to talk about the mortgage market and some of the other aspects of these, what's going on.
Thank you, Michael. You always do a fantastic job of putting data onto spreadsheets and telling us what the data means. I think that is a huge value to everyone on this call. So thanks for all of your wisdom, and you've had a ton of experience at, so we love the fact that you're giving us your outlook and your opinion. That's important. So thank you for that.
Thank you.
Yeah, you're welcome. I hope everyone, first of all, is healthy and joyful in these challenging times. I wish I could be with all of you in person, but at least we do get an opportunity to still interact and share knowledge with each other to help each other through these difficult times. So I'm going to be discussing today, these are the topics: the CIA test, credit, income, and assets, a forbearance update, Fannie Mae, Freddie Mac, and FHA updates and to the mortgage side, appraisal updates, bid-ask worksheet. This is going to help with bidding wars, a different perspective, risk-based pricing, record low interest rates. Now that is actually putting a boost to retirement. We're going to talk about affordability factors. We're going to talk about the 2-10 Treasury yield spread update. And then I'll close with about a 7-minute presentation on a national housing outlook. It's important to know local, and that's what Michael just talked about, but sometimes it's nice to compare the local to the national housing and see if there's any difference in trends. So diving right into this. In times of uncertainty that we're in with COVID, we have to get back to basics. And what basics in the underwriting world means is credit, income, and assets. I always tell people if they can pass the CIA test, they can get a loan. And CIA stands for credit, income, and assets. And it's very important today, more important than ever, for underwriters and lenders to be focusing on those 3 topics to make sure we can get families into homes. So I'll talk about some of those changes and how those changes may be affecting you agents with your sellers and buyers. Some advice I would give to you agents: when you're talking to your buyers and sellers, encourage them in this challenging environment to make the process as easy as it can on themselves. Online banking is almost a necessity for borrowers to be able to go through the underwriting terms these days, the underwriting process. Having people waiting to get bank statements in the mail, having people not be able to log in and get transaction summaries makes it very challenging to close escrows on time. So I would encourage online banking. Another thing, agents, I would encourage your borrowers, buyers and sellers, is electronically filing documents. Be prepared. Have their documents electronic for CPAs, their tax returns, bank statements, pay stubs, all of that. If they can have it in a place where they can easily get it and send it, it's going to make these 30-day escrows a whole lot easier to hit. Because I can tell you, appraisers are busy, title and escrow companies are busy, insurance companies are busy, lenders are busy. Everyone is busy, and their turn times have expanded. And if the borrowers aren't able to do their job quickly, it's really challenging to meet these 30-day escrows. So that would be some advice I would encourage your agents to have with your buyers and sellers up front. Forbearance update. I'm not going to go into the length I did in the last seminar, but I think it's important to give you some updates. When it comes to forbearance, I'm going to call that a penalty box. When anyone decides to use forbearance, which is basically hitting a pause button on your mortgage payments, that puts you in a penalty box, which means you cannot borrow money to buy a home or refinance a home. And when you have the lowest rates in the history of the country, a lot of people want to take advantage of buying and refinancing. So if someone is in forbearance and decided to take advantage of that option and hit pause, what are their options coming out of the pause when they hit play? The first one, which is the best way to come out of the penalty box so that they can refinance or buy, is a lump sum payment, or what I call reinstatement. So someone is 90 days behind, okay? The servicer's been making those payments. I talked about that in length the last time. So it's not affecting their credit when they went into forbearance because the servicer continues to make the payment. But when they come out of it, if they make the 3-month lump sum payment, they automatically come out of forbearance and they can go refinance and buy immediately. So that's the best option, agents, for your buyers and sellers to be able to take advantage of this market. Another option is a payment plan. That's similar to the reinstatement lump sum, but instead of making a lump sum for all 90 days at once, you make it over 12 months. That option isn't as popular if you're trying to buy or refinance, because it still will keep you in the penalty box for a minimum of 4 months. And the reason I say 4 months, it'll take your lender at least 1 month to draw the paperwork up for the payment plan, and then he requires 3 payments after the payment plan to come out of the penalty box. So that would tie someone down for 4 months. So that is an option. The next option, which is the most common for anybody who doesn't care about refinancing this year and doesn't care about buying this year, and that's a deferral option. That's where they take the 3 months that they put paused on, it gets added to the end of the mortgage, and then once they made 3 payments after the deferral option started, then they can refinance and buy. So that'll also take about 4 months, because it'll take 1 month to do deferral paperwork and 3 months to show you've made your payments after the deferral process has started. So that would allow people out of the penalty box to buy, sell, or refi. Well, not sell, but buy and finance and refi in 4 months. The last option is going to be the least common option, and really is the last resort for borrowers who maybe are not back to work, not back to full employment, can't afford to make their mortgage payments. This is a last resort to a short sale and foreclosure, and that is a loan modification, where you go in and you actually change the terms of your loan to have a lower payment with a lower interest rate and extend out your amortization so that you don't lose your home. So that's the least common. And if you did take that option, you would be in the penalty box for 12 months after the loan modification is finalized. So that would pretty much take someone out of buying with a mortgage or refinancing. So I hope that is clear for your buyers and sellers who maybe find themselves in a forbearance situation. Those are the 4 options, and that's how it would affect their ability to borrow. Fannie Mae, Freddie Mac, and FHA updates. I'm going to go over a couple of them that I think are the biggest ones that are going to affect you agents and your buyers and sellers. The first is a self-employed rule change. It's surprising to me the lack of information that's got out to the real estate community. So I'm really excited about sharing this with you so you know about it, because no one's half the hour here with your buyers and sellers, so you don't have surprises. If you're self-employed and you want to get a loan from Fannie, Freddie, or FHA, you've got to give 2 months of your most recent business bank statements with a profit and loss for year-to-date 2020, and the business bank statements have to show that the business is operational and is making income. And then the profit and loss has to jive with the bank statements, showing that you're still profitable. So if you have a client who made a really good living in 2018, 2019, been self-employed for 20 years, okay, but they're not operational at 100% right now, and they're not putting nearly as much money in the bank as their businesses are used to, they're most likely going to struggle to get a loan. So it's unfortunate because they had maybe 10 years of good income, but the last 2 months or last 4 months, if their business bank statements and P&L does not support the income, we have to use their income from this year. So that's a real struggle for self-employed individuals. I want you to know about that. Assets. They changed how long assets are good for. Typically, when you got a loan, your assets were good for 120 days. Because of COVID and the concern that banks have about people using all of their savings, they want to document 60 days of assets before closing. So if we're going to close in the month of August, the month we're in, we would need June and July statements for their assets, where before we could have got away with May and June. So it's causing your borrowers to do more work and keep their file updated with current assets, which is a struggle for those people who don't do online banking. So once again, I encourage the borrowers to be disciplined and ready for this process. So that's been a change with assets. The verification of employment, there's been a major change there as well. Typically, we would verify as a lender employment for employees and self-employed individuals at time of the loan docs being drawn and approved. And then that would be the last time we did it. The problem is there's a delay between the time a loan is approved and the time we close. And sometimes that delay can be 2 or 3 weeks. And it's happened dozens of times that I know about at my company, where people have lost their job, unfortunately, from the time it was verified at approval and the time it was verified at closing. And so these doc drawers and funders who are funding loans, at the very end, they're having to get in touch with the employer and verify again verbally. And with people working remote and people being out of the office, sometimes we can't get that verification the day we're closing, and it will delay a closing for 24 hours. And everyone's upset. Obviously, agents are upset, borrowers are upset, but we have to be able to get a hold of these employers and verify they're still employed. So that's been a change. So we need agents to be patient with this process, we're doing our best to make sure we get the names of people that we can contact to verify time of funding, because those people could be sick that day. So, you never know what's going to happen in the mortgage business or real estate. So that's been a change. Furlough income issues. I get this question a lot. If someone's been furloughed, they're back to work and they're working 20 hours a week instead of 40 hours a week, we have to count the hours they're working now. We can't average it over the year. It needs to be what they're currently working. And so if 20 hours is enough to qualify, great, then we can move forward. If they need the 40 hours, then unfortunately we're not going to be able to use the income because they're not fully employed. It's a really common question. It can't be averaged. It's what you're doing right now at work. FHA 6 months reserves. The reason I bring this up, you might not think this happens a lot, but with everyone moving into suburban and exurbs areas I'll talk about later, FHA is actually a really common vehicle for people to finance $300,000 to $400,000, $500,000 homes. And if someone's trying to count rent on homes they're leaving to go into new areas, they need to have 6 months reserves before they can count the rental income on the home that used to be their primary. That's a new change because of COVID with FHA, and that's been catching a couple buyers by surprise because we can't use the income, and now they don't qualify on their departing residence. So those are some of the changes that we're seeing, that we're running into more consistently, that I want you to know about. So please reach out to your lender to talk more about those issues. Appraisal update. This is a hot topic right now. And a lot of you have probably heard about property inspection waivers. We're calling them PIWs. If you're doing a Fannie Mae or Freddie Mac loan, property inspection waivers are given a lot of the time if the current owner of the property was Fannie or Freddie. And that's a real blessing for buyers and sellers because one, appraisers don't have to go into the property. Two, the buyer doesn't have to pay the fee for it, which saves them money. And three, you don't have sellers that are concerned about someone coming into the property and maybe seeing that the fact that there's something not complete in the property, like a bathroom's not done. So it takes some of the hurdles that you could come across out of the picture. And so you'll see a lot of property inspection waivers happening. So as a listing agent, you might have heard about that, or as a buyer's agent, you might have heard your buyer not being required to have one. So that's a blessing that we're getting more Fannie Mae and Freddie Mac property inspection waivers. Regarding appraisal value concerns, we have seen in the last 90 days, the appraisals by probably double. So I'm going to say 2 to 3% where we were 90 days ago. In the last 90 days, we're closer to 6%. We're seeing a lot more appraisals come in below the selling price, and that's obviously requiring buyers and sellers to come and renegotiate. But that is unfortunately something that's probably going to continue to happen when we're in an environment where appreciation is rapidly happening. But we are seeing it. The good news is most of the time the buyers and sellers have negotiated somewhere in the middle and it hasn't canceled a lot of transactions. So that's positive. And the third one you might have heard about with appraisals is the drive-bys. We are also getting drive-by appraisal approvals through the loans with Fannie Mae, Freddie Mac, and FHA. And it depends on the type of loan they're getting, the occupancy of the loan, how much money they're putting down. So please reach out to your lender and ask them if there's concerns with sellers letting someone in the home, if a drive-by appraisal option is available, and they should be able to tell you that when they run their DU or their AUS or LP. So that's great information and very helpful for buyers and sellers and for borrowers to save some money. All right, this is something I'm pretty excited about. This is a bid ask worksheet. And this is a great worksheet that you can get from Franklin Loan Center to get to your buyers to change their mentality about maybe giving a higher bid over ask and paying a little bit more money. In this situation here, it was a $539,000 asking price. The buyer had to come in with 15 grand higher to win the bid, which they did. So they ended up paying $554,000. Okay, but based on forecasted appreciation in this market of Riverside, this actual flyer will show the buyer that by November, if they close in August, by November, based on forecast appreciation, they would already have made back the money that they overbidded on the property, and they get the property they want. And based on what you're going to hear in this presentation of Mike's and Brady's, I think you're all going to be agreement with us that values are going to continue to go up and will for some time. So having your buyers' mentality shifted to maybe paying over the list price is something they need to get comfortable with because things aren't going to change very soon. And this is very easy for us to produce, which will show them the appreciation over the next 5 years in this situation and how quickly they'll get back the over bidding price on the ask. So if you want this flyer, please reach out to your Franklin Loan Center representation and we can get it for you. All right, this is one of my favorite topics to talk about, and this is risk-based pricing. Because agents, you guys are the experts and you are supporting your clients and walking them through this process or shepherding through this process. So you need to help keep their emotions in check. And sometimes as agents, you'll hear about one client getting a certain rate and another client getting a much higher rate. And your first thought is, oh, why are they getting such a high rate? Are they getting ripped off? And then they tell you they're upset. The best thing to do is to reach out to the loan officer or the mortgage banker and ask them why the rates are higher. Because you can send a client to Franklin Loan Center and they can get 2.5% on a 30-year fixed rate at no points. And you can send another client the same day in the same morning and they can get a rate of 4.5%, a 2% difference. And the loan officer doesn't make any more money based on the rate. So the loan officer has no advantage of giving a higher rate other than losing a deal with someone else. So there's a reason for the higher rates. So I want to tell you why risk-based pricing and how it works. If you're going to lend your own money to someone and they have bad credit with no money in the bank, in an in and out job, you're probably going to see that as risky and want more money for the money you lent. Well, the banks think the same way as you would think with your money. So this is how they look at the risk-based pricing. The first is occupancy. Primary residences have the best rates. Second homes, second best rates. Non-owners, the highest rates. And that's just based on the default rate risks of those three properties. Second is FICO scores. If you don't know about FICO scores affecting your interest rate, then I don't know what rock you came out of, but you need to come out and do some reading because FICO scores has a huge impact on the rates your clients are going to get. Third, down payment. How much money they're going to put into the transaction also affects the risk of that transaction. So someone with a low FICO score put a lot of money down might still get the same rate as someone with a good FICO with a little bit of money down. So it depends how they all come together. But down payment, the more money they put down, typically it's going to help them with their interest rate. The next thing, and sometimes a lot of agents don't know about this piece, but the property type. Single family residence has the best rates. PUDs are basically the same, so those are the same, but condos have higher rates because the default rate risk on condos is higher because it's more of an investment. People buying short term, they're not really committed to it. Sometimes it's an experiment. Do we want to be here? Do we like it? So it's not very common for people to really dig in and carry those condos if they don't want them. So the rates are higher on condos. Another thing is loan type. Purchases have the best rates. Refinance, rate and term, you pull no money out, very close to those purchase rates, which are also very good. But cash out refinances, when borrowers are taking money out of their home, which makes the home have less equity in it, it's going to cause a higher rate because it brings up the loan to value. So it's really important to understand the type of loan they're getting as a purchase or refi. And last is mortgage insurance. Believe it or not, when someone gets mortgage insurance on their loan, it actually improves their rate. And let me tell you why. Mortgage insurance is an insurance that the borrower takes the loan out, pays monthly to insure the lender. If there's a loss, the mortgage insurance helps to make the lender partially whole. And so if the lender is going to have someone committed to helping them if there's a loss, they're going to offer a better rate. So once again, all risk-based pricing. So that's all great information for you to pass on to your borrowers and sellers and your clients of why rates can be so different. This is another spreadsheet that I'm pretty pumped to talk about because this gives a different perspective on interest rates. So we have record low interest rates, and this is really going to encourage early retirement down the road. Let me explain what I mean. If someone today is 45 years old, which is what the age is on this flyer here, and they want to retire at 65 years old, and they want to have $50,000 a year in income above their Social Security, and they currently have $185,000 in the bank, I made a couple assumptions, 8% return over the next 20 years while they're working, and 5% when they retire. They would need $1 million in the bank to have 50 grand a year in income. Right now, they have 185,000. So they only need to save $231 a month for the next 20 years, and they can retire at the age of 65 and have their desired income. So why do I bring this up? Because right now, the average interest rate going into COVID-19, which is giving everyone an unbelievable opportunity to get low rates, was 4.25%. Now people are getting rates at 3% and lower, and people are saving anywhere from $250 to $500 on those savings from 4.25 to 2.5. So if people just take that savings because of these low once in a lifetime opportunity rates and put it away instead of spending on maybe lifestyle or buying things they don't need, they're going to find themselves in a much better position to retire. So you're going to see a lot of people retiring in their mid 60s, 20 years from now, because of this opportunity with low interest rates. So take advantage of these rates. And not only can it save you money now, cash flow, but it can set you up for retirement. Affordability factors. The three things that affect affordability is income, interest rates, and down payment or money, one and the same. And I want to talk about all three because right now, in my opinion, affordability is at an all-time high. And a lot of you might be thinking when you hear that, well, how can Walter say that when prices are so high? Well, I'm going to address the prices, but let's just talk about the affordability piece. Income is the largest factor in home affordability. And income, in my opinion, I'm going to say more than 50% of people right now are making more money than they were 6 months ago. So more than 50, but let's just say for this argument, 50% are making more, 50% are making less. So let's say it's neutral. The second biggest factor in affordability is interest rates. Well, we already know interest rates are all-time historic lows. So that's going to make affordability at the highest level ever. So I put an arrow down. So that's good. Affordability is getting better because rates are going down. The third factor, which is the least important, is how much money they're putting down. So you could say that's stock market, how much money they have in the bank and savings, all that. That's the third biggest factor. That's the least important. But I will tell you today, most people who didn't take their money out of the market in March when COVID started, they have more money now. They've come all the way back and we're setting new highs right now in the S&P. And so people have got all their money back. So I can make an argument people have just as much money in the bank right now as they did a year ago, if not more. But I'll just say it's 50-50 again. Okay, so is affordability up or down? In my opinion, with two factors being flat and one being really, really good, I'm going to say affordability is up, not down. I think a lot of people think it's down. Affordability is not down. If it was down, then you would see less people buying homes and inventory going up. So that's a really positive sign for you agents and buyers and sellers here moving forward. Home mortgage update. Here's a couple things I want you to know about what's going on in the mortgage business. Jumbo loans. There's a lot of misconceptions out there about jumbo loans. A lot of lenders and banks are not doing that. That is true. But there's a lot of people that are doing them. Franklin Loan Center, we are doing jumbo loans, and we've got great programs with great rates. But jumbo mortgages are hypersensitive on the CIA test, more so than Fannie, Freddie, and FHA. They don't let you do, they're not as flexible. But the one thing that's going to make jumbos more difficult for your clients is the reserve requirement. They must have really good reserves in the bank, which means after they close on the home, they put their down payment, they pay their closing costs, they're going to have sometimes as little as 12 months reserves on the mortgage, as high as 36 months. So that's the thing that's making some people feel frustrated, but that's what you need to know. So if you've got jumbo people wanting to borrow money, they can do it, great rates, but the reserves is a sticking point now. Non-QM bank statements, they're back. You know, as of 4 or 5 months ago, non-QM bank statement loans went away. They're back. They're not back at full force. They're still challenging to get done, but it can be done, and we're doing them. Franklin's got a proprietary bank statement program. We lend our own money, so we're doing them. So send those buyers our way because we can do them. Bridge loan financing. We've still got our bridge loan financing product available for all of you. The good news is you don't need it nearly as much today as you needed 6 months ago because a home is being listed and it's selling like that. It's, you know, there's bidding wars on it. And so that's a positive sign. But if someone can't get it sold and they need money out of it, we have a product to help them and we're still offering it. We've never suspended that. And the TBD underwriting, to be determined property for underwriting, we can still do those for you. If you have buyers that are being beat out on all cash offers because of the multiple bids, it's a little slower for us to get to the TBDs because of underwriting the loans we have, but we can get it done for you. So that's an option for you as well. So I hope that brings some color to some of the misconceptions on those products out there. I always want to talk about this chart in every presentation I do because I think this is the best chart to predict and forecast recessions. Lots of people think we're in a recession right now. I personally do not think we're in a recession. what this chart shows you, you'll see the gray lines on the chart. Those are all recessionary times. You notice every time we went into a recession, you would see the red lines start to occur. And then when we come out of recession, you'll see green lines. The red line means 2-year money was more expensive to borrow than 10-year money. Well, that makes no sense. If you put money into a CD for 10 years, you should get a better rate of return than 2 years. That's correct. But when you're in a time of uncertainty, short-term money is so valuable because people want it, they'll pay you more for it. So right now you can see the last recession we had, how wide it was as well. But you can see all the way above 2020, there's a little red dot. We did go negative for about 4 days on the 10-year Treasury, but the Fed came in, stimulus, pulled us right out of it. And in my opinion, that doesn't qualify, that 4 days, as the beginning sign or trigger of a recession. So right now, this tells us we're not in a recession. Important to understand. Okay, housing outlook. This is a national housing outlook, and what you're going to see in this presentation is very similar to what Michael was talking about and what Brady was talking about, and what Brady's going to be talking about. People are waiting longer to get married. You can see on this chart, the blue line, men are getting married around 28 years old, and women are getting married around 26 years old. And why is this important that people are waiting later to get married? Because housing and family is driving housing. And what I mean by that is, if you have no children, you're married with no children, you're 38% likely to buy a home. You get married with one child, you're 80% likely to buy a home. So family drives housing, especially entry-level housing. And because people are getting married later, they're having children later. And check this out. This is Google search baby registry. They've been tracking this since January 1st of 2004. We are at the highest level of people going on and setting up a registry for babies they're expecting or babies they've had. So we've got a ton of children being born now and will continue to be born over the next several years. That is going to drive housing. We have increased population growth and we have less inventory. So I'm going to get into that. So this baby boom we're going to be having is only good for real estate and is good for your buyers and sellers out there. I'll go even further. What are these buyers looking for today? More space and distance. This is a chart. The blue line is for urban. People leaving urban areas. You can see as of 2015, people started leaving urban areas. You're just hearing about the trend the last 6 months, but you can see the trend's been going down, down, down since 15, all the way down 19. And people have been going into the exurbs. The exurbs have been going on. What are the exurbs? Well, you got the suburbans, which are outside of urban. The suburbs have always been popular the last 4 or 5 years. People have been going right outside the city, going to the suburbs. That's been a trend that's popular. But the newest and hottest trend is actually going right outside the suburbs, which are the exurbs. People are wanting even more space, more land. So you're going to see this trend continue. It's been happening since 15, but no one's been talking about it until recent COVID. So I'm not surprised about what is happening and why people are buying outside of urban markets. Young adults drive growth in home ownership. We talked about the children. We talked about the adults having children growing it. And that's why under 25, the under 25 is up 2.5%. 25 to 29 is up 2%. And 30 to 34 is up 0.5%. Those are the 3 biggest increases in buying real estate. And so if you want to know where to focus your money in marketing, it's on the youth. And this is why. Here's an example. How often do the young move? Over a 12-year period, historically, under 35, they move 4 times. They move 4 times after being 35 years old. Over the age of 50, they move once. And so getting people early on when they're buying their first or second home, they're going to move a lot more. And so that's been the statistics, and that's who you should be marketing to. All right, inventory. This is a national picture of inventory. And you can see the average, that going back 40 years, was 2.5 million homes listed for sale. That's the average over the whole period. You can see the bubbles, and Michael talked about this. I agree that we're not in a bubble situation. We had 2 peaks with really high inventory. You can see the 07 peak of 3.7 million, and you can see the peak of the late 80s. Those are housing bubbles. Real estate was affected in those 2 recessions only. Look at where we are today, 1.8 million, 19 year to date, lowest ever. So inventory is low and we have increased population coming. So prices can't go down. And this is even, the next chart's going to tell you why they have to continue to go up. Here's COVID slows new construction. There's less inventory. You can see the line up, going all the way back to July 2010. More you can see, and on the left is thousands of units being built. Look at the huge drop off we had at COVID. People stopped building homes. And so if builders aren't building new supply and inventory is already low and we have growing population coming with children who buy, inventory can only go down. So that's really important to understand that. This is a really cool thing as well that I'm excited to share with you all. It's price to rent ratio. And if you do the numbers, you're going to agree exactly with this. What am I talking about? Current price to rent ratio. Well, currently we're at 17 times. What I mean by that is the price of a home is 17 times its annual rent equivalent. So let me give you an example. $1,000 per month on a home for rent times 12 months is $12,000 a year that home gets for rent. If you take 12,000 and you times it by 17, you get $194,000. That should be the value of a home that rents for $1,000. That's renting for $1,000 today. I can give you another example. A $300,000 home should rent for roughly $1,500. That is another example of 17 times. If you go look at some of the homes you've recently sold and look at what would rent for long-term in the current market, you times it by 17, you're going to see that's pretty close to what these homes are worth. What was the peak in 2006? And this is my big point here, my aha moment on this, 24. It was 50% higher than where we are today. So we are nowhere near the 2006 real estate bubble high, because based on rents, what people can charge, based on the sales price, it's actually much healthier than it appears. Equity. Let's talk about equity. This is a chart. Blue line is the fourth quarter of 2019, and the green line is the first quarter of 2020. And this shows you how much equity people have in their homes. And you can see on the very far left that almost 10% of the people in this country have got greater than 50% equity in their home. If you go all the way to the right, you'll see that less than 2% of the people in the country don't have equity in their home. So only 2% of the people don't have equity in their homes that they own. That's a really positive sign, because I don't know if you guys have done the research on the tech boom and the tech bubble busting, but what got us out of that bubble was equity in homes. People started pulling the equity out of their home to survive the downturn. So if we do have a recession coming and we do have a downturn, what's going to pull us out very, very, very quickly is all the equity people have in their homes. So this is very promising for if a recession comes next year, the year after, it should be a very shallow recession. Going a step further on a housing overview nationally, there's 124 million households nationally. 43 million of those are people who rent homes. 80 million of them are people who own homes. So let's break down a little bit more further. 34% or 27 million of those homes are owned free and clear. No mortgage, no debt. That's a huge piggy bank for rough times. 66% or 43 million homes have an average mortgage of 53%. So they almost have 50% equity, which on the national median means 177 grand in the bank. So once again, equity positions are strong, and that's going to allow people to feel very comfortable about the future, knowing they've got all that equity in their home. So my appreciation forecast for 2020 and beyond on residential is solid. I think you're going to see, as Mike said, don't be surprised if you see year-over-year gains of 5 to 10% the next 2 years. And so that's a very promising side for the real estate market, and it'll give us a backdrop to pull out of any next future recessions. I want to thank you all for attending. Thank you for all the support you give Franklin Loan Center. We could not have been supporting you and serving you for 31 years without you giving us the opportunity. So we appreciate you all. We wish you a healthy and joyful rest of the year, and we're looking forward to connecting with you very soon. Next, I would like to introduce Brady. I'm excited for you guys to hear what Brady has to offer. He's so well spoken, has so much wisdom. I take notes every time he talks. So I want to welcome Brady to the stand.
Walter, thank you so much. It's truly my pleasure to share a virtual room with you, as well as one of our great friends, Mike McDonald, and to all of our ladies and gentlemen out in Coachella Valley and those watching from beyond. Thank you so much for choosing to lean into the conversation where we can talk about the market of the moment and answer the big question, will the sales continue? But before I get started, I want to say thank you for showing up every day over the last 6 months to lean into those people who want to sell and those people who want to buy. So congratulations on showing up for work. I know there are enormous amount of distractions. You've done an excellent job of keeping those out as much as possible and going down the road. You know, it's no surprise that business, specifically sales, happens in a 90-day cycle. So let's take a moment and look back at the real estate industry. In fact, most real estate agents will have 2 quarters of success. Those quarters are typically first quarter and third quarter, or second quarter and fourth. Notice it's 3 months of intensity, 3 months off, 3 months of intensity, 3 months off. And in our group, we help our ladies and gentlemen have 12 months of strong success. In other words, you're selling and moving forward at the best possible rate you can. But really looking at the industry, success happens in 90-day cycles. So let's take a moment back to March 2020. Middle of March, we became survivors. We were looking to survive in the market of that moment. March to April, April to May, and May to the first part of June, we were in survival mode. Now, the switch, it's been flipped. We're in thrive mode. So from June to July and July to August and probably August to September, we are now thriving. So remember, market cycles do typically happen in 90-day periods. Right now, we're in a very strong market cycle. Now, the question that we're here to answer today is, will the sales continue? And while no one knows, the data from Mike and Walter suggest that the market of the moment will continue for the next couple of months. Let's take a look at some of the obvious reasons why. Number one, for the last 6 months, people have figured out that they can work from home. So they're moving out of big urban markets like San Francisco, like Los Angeles, even San Diego. They're getting rid of those high urban, high density populated markets, and they're moving to Coachella Valley. Tongue in cheek, wouldn't it be fun to take the next conference call poolside rather than in a tight office space? So many of your customers, I'm sure, are like ours. They're moving out of those big cities and they're working here in Coachella Valley. Number two, people have figured out that they want to travel to their vacation homes and they want to do it by car, not by plane. That's why so many buyers are coming from those coastal markets. They typically would go west to Hawaii. They may go south to Mexico. They may travel east. However, right now, their perception is they want to travel to their vacation homes by car. So they're buying up those secondary homes. They're turning them into their easy to get to vacation properties. And finally, those investors who may have volatility in the stock market understand that they can make short-term and long-term rental profits from the rental properties here in Coachella Valley. In fact, Airbnb just named Palm Springs as the #1 place to profit out of short-term vacation rentals. If you haven't seen that link, Google it, it's there. Note to self, Lahaina, Hawaii, #2. Nashville, Tennessee, #5. Palm Springs, #1. That's fueling the amount of investors. So when we look back to Walter's slide about how people get their rates, remember, full-time residency, secondary investment, it's in that order. Be aware of the data around the financing. Now, when we look at those factors, people who want to work from home, people that want to vacation by car, and people that want to invest in the market, we have to recognize there are other external factors which are driving the market at the moment. Number one, interest rates are so low that people who had no interest to buy are choosing to buy. Why? They're hearing about their friends or family getting interest rates under 3%. Ladies and gentlemen, under 3%. That doesn't mean everyone's going to get it, but some people are, and that's causing people to buy real estate even if they had no interest in doing it before. We also have people that just want to get the entire family together, right? They're They're realizing they can get a larger compound for less money or keep their cost of ownership lower because the interest rate is so much lower today than it was years ago. Now, when we look at how we can keep the market moving forward, remember that we're 3 months into this thriving market. We can't rely on motivation as much as we need to rely on discipline. So I'm going to give you 10 tips that you can use to stay disciplined in selling for the market at the moment and prolong the success that you've been having the last 90 days. Number one, we have to understand that we have to know the current market statistics. You have to log into your MLS every single day and look at what is coming on the market, look at what is being purchased by buyers, otherwise known as contingent accepting backups, and look at what's actually closing, because ladies and gentlemen, it's no longer about what properties are selling for. The conversation is more about what buyers are buying. So be aware of the market data of the moment of that day. I guarantee you the market data is probably changing faster than you realize. Number two, we need to stay ahead of current market conditions. For example, some cities have put in moratoriums on short-term rentals. Some cities still have the gates open for short-term rentals. Some cities are talking about outside dining. Some cities are talking about keeping things closed. Those market factors of those individual cities will drive or stall the micro market of that particular city. So have your radar around Coachella Valley. Be aware of what's going on with each of our great cities. Number three, we have an obligation to make sure we have saleable inventory on the shelf. Ladies and gentlemen, in many ways, you're running a clothing grocery retail store. If we don't have enough product on the shelf and that product is not saleable, the buyers have nothing to buy. So for those of you who specialize in taking listings, keep taking those listings. For those of you who are working primarily with buyers, ask your clients, have you thought about cashing out right now to someone else who could own this home? So really keep that product on the shelf. Number four, be aware of where buyers are coming from. Understand why they're coming to the Coachella Valley. Be clear on what they're looking for and be very clear on what they're willing to pay for it. See, back in the day of a more normal market, we would talk about how to get a property sold. The conversation today is, let me share with you where buyers are coming from. Let me help you understand why buyers are coming to Coachella Valley. Let me share with you what they're looking for, and more importantly to a seller, how much they're going to pay for the features that they want. So be the expert in buyer behavior. Number five, we have an obligation to be communicating with our clients and each other more so than ever before. Now in our group, Brady Center Real Estate Group, we counsel our ladies and gentlemen to follow what are called the 4 C's. Number one, every conversation starts with care. We have an obligation to put our ego to the side and lead with care. Find out how your customers and your peers are doing. Number two, the second C, go in with curiosity. Ask them a series of questions. Find out what's going on in their world. I guarantee you when you ask those questions, real estate will naturally show up, which leads to the third C. That's when you can step into consultant role, right? You've shown care, you've been curious, then you can be the consultant. You can help them understand the market data, the market of the moment. And finally, that fourth C is close them. You have to figure out if they are ready to be doing business with you today, or if they're going to be better ready down the road. But if we cannot close them to the next conversation or the next appointment, if we can't close them into the offer or the counteroffer, if we can't close them in the request for repair, we're really not doing themselves a favor, and we're certainly not helping our real estate business. Point number 6, ask more questions of the people that you're communicating with. This involves agents on the other side. This involves lenders that you're working with. This involves people that are part of the transaction. This doesn't matter if you're a team of 1 or a team of 12. We have an obligation to ask more questions, because the better question that you ask, the more clear answer that you'll be given. So don't be fearful of asking questions. I suggest to our ladies and gentlemen that we practice questions on our peers, not on the people that pay us. So ladies and gentlemen, every great professional, every great athlete, every great performer, every great real estate sales professional practices every day. Believe me, when you practice, you'll increase your confidence, you'll increase your skill set, and you'll get the outcome that the client wants sooner than later. Point number 7, please, on behalf of all of our ladies and gentlemen, work with local affiliates. More so than ever before, work with local lender like Franklin Loan Center. Work with local escrow and title companies. Work with your local home warranty companies, right? Keep the conversation in Coachella Valley, keep the communication here, keep the revenue here, keep the service, keep our ladies and gentlemen employed in Coachella Valley. Number 8, we have an obligation, and I mean this seriously, to support our managers and our brokers who are carrying the heavy weight of the storm right now. Ladies and gentlemen, if you're in sales, you have the opportunity to make an enormous amount of money. If they're a manager or broker, they're in that position because they like to help people. They like to help you. So please reach out and share how much you support them, how much you appreciate them, because I know that will go a long way for you and will mean a great deal to them. Number 9, we've been in this thriving market for 90 days now, right? A 90-day run, which means some of you are a little tired. I hear it. I'm just like you, working with sellers, working with buyers, working with you. I hear through the phone how tired you are. So remember that right now is the time not to worry about motivation. The time is to fall in love with discipline. Fall in love with the discipline of your schedule. Fall in love with the discipline of taking calls and returning calls. Fall in love with the discipline of checking your email and getting back to your ladies and gentlemen as quickly as you can. And remember, you may be a team of 1 from a real estate perspective, but you have a team, escrow and title and lending and warranty. Those ladies and gentlemen will help you move along the road towards discipline. And finally, number 10, we need to remain healthy. Physically healthy, mentally healthy, financially, emotionally, spiritually healthy. This is a tough time, but it's also the time to shine. So remember, if you're having any levels of doubt, that first thought in your head generally can be a negative one, but that second one should be great. It's probably the best words of wisdom I learned from my great coach, Mike Ferry, and that is, the first thought that comes in your head may not be the best one. The second one should be a great one. On behalf of our entire group at Brady Sandal Real Estate Group and all of Keller Williams Luxury, if there's anything we can do to help you, please reach out. It's been our pleasure.
Thank you, Brady. That was great. I'm going to bring back all of our speakers so we can do our question and answer portion of today. You guys all hear me?
We can.
Yes, we can. I can.
We have some good questions. That was wonderful, you guys. So our first question is for Mike. If we continue along this trajectory, what will it mean for housing in the Valley in 1 year?
Oh, that's a good question. In 2011, during that was the ending year of that terrible foreclosure crisis that we went through. Prices that were driven very, very low. People were negative at the time. Market Watch came out with a number of reports saying we were expecting a 25% gain in home prices. People didn't believe it, but we actually was exactly right. It was 25% was the average gain in the Valley, including other regions. So it marked a turning point at that point. I have a feeling, based on 50 years experience, we have the same similar conditions here. We've got this 4.5 year, let's get past the pandemic. We have a 4.5 year decline in inventory. We have record low interest rates. We have demand in the Valley higher than ever before. This are the conditions that I witnessed before for something unusual to happen. Bidding wars. I would not be surprised to expect another 10 to 20% gain this year. I know it's kind of sticking my neck out, but I like to do that. It's kind of the way I am. But I wouldn't say it without seeing these conditions as they are. So to answer your question, I'm expecting a fantastic year price-wise. And that, by the way, I think will help with the inventory problem. That'll bring out more inventory. Agents will be able to find more properties to sell. Plus, hopefully, if we get some more price gain, new homes will begin. We still have a very kind of depressed new home market. That will start turning around too once prices go up. So I'm very optimistic.
Great. Thanks, Mike. Walter, this question is for you. If I was going to refinance my mortgage, what should I be aware of? Oh, we can't hear you, Walter. Let's make sure we've got your mic on.
There's 3 things you need to be aware of. Obviously, interest rates. Everyone wants to have the best rate possible. 2, what is it going to cost to save the money? Because if you're going to pay a lot of money to save money, you have to figure that out and when your break even is. But the thing that no one talks about, and I personally think is probably the most important piece, is the amortization of the loan. The amortization of the loan, the goal of taking a mortgage out is paying it off. So if you have 20 years left on your loan and you go back to 30 years and you're saving $300 a month, now you've got another 10 years of payments. So when you're looking to do a refinance, please look at maybe doing an amortization that's in line with the one you're coming out of. So maybe ask for a 20-year fix or a 15-year fix and see if you can still save money. If you can, then that's the best way to go.
Great. Thank you. Brady, I would think that this market would attract a lot of new realtors and possibly realtors from outside of the market. Any words of wisdom for them?
Well, being in real estate is probably, my favorite industry, which is why I've been in it so long. And it's a great time to get in the real estate market. And naturally, we'll probably see more people get into real estate, especially as unemployment continues to rise. Certainly, we are licensed in the great state of California, which means we need to be ready for agents to come from out of market into our market. We believe in our core values that we have to anticipate, serve, perform, inspire, respond, and exceed expectations, which means we welcome them to come into the market. We make sure that they understand the dynamics of the market. And if they're not comfortable representing their client, we are happy to give them a referral so we can help their clients get what they want in the time that they want.
Great. Walter, this one's for you. How long do you expect interest rates to stay low?
Well, I wish I knew exactly the answer, but the Fed has told everyone that they're going to keep rates low for all of 2020, 2021, and maybe 2022. That being said, I don't think the Fed has got the ability to guarantee what rates are going to do. The free market is much bigger than the Fed. What the Fed has going for it, the reason they've been successful keeping them low and maybe able to keep them low, as Brady said, 90-day cycles for at least the next 90 days, is there's so much debt being produced, so much debt being rolled out nationwide through the globe. It allows us to continue to print debt if everyone else is printing. But if people stop printing debt, then we have to stop printing debt, where our currency gets devalued and then inflation comes into it. So as long as the world continues to print debt, we will continue to print debt and keep rates low. I would encourage people, this is my warning to people, if rates pop up 0.5% in 90 days, you're going to see this market come to not a standstill, but not a stop, but it's going to slow. I would encourage people to work hard, just like Brady said. Be encouraged, have good stamina, do those things that Brady talked about. Take advantage of this market, because this market won't stay forever. Rates have a lot to do with it, but I think you'll see rates stay below 4%, I would say, for the next couple of years, maybe not 2.5%.
Great. Brady, you spoke about the importance of lead generation. What are some of the new ways you and your team are finding those leads?
Right, so we're a firm believer in communicating with 3 audiences. Number 1, the clients that we've had the pleasure of serving, and we still choose to communicate with them by telephone. We also back that up with digital communication as well. Number 2, we communicate with people that we've not had the pleasure of helping yet, Either there are owners who will be sellers or shoppers who will be buyers. And third, we lead generate in with local agents and out-of-area agents who are feeding into our market as well as, helping them move into their market. So for example, feeder markets, San Francisco, Los Angeles, Orange County, San Diego. Downward markets would be Las Vegas, Nevada, obviously moving for tax reasons, Phoenix, moving for state reasons, right? And then going east. So 3 groups: clients that we've helped, clients that we want to help, and agents in the industry.
Great, thank you. So Brady, I have another question for you. It seems to be the question of the moment. We asked it last time and people are interested again. Should they sell now or should they wait?
It's the question, right? It's the $1 million question. Do you sell at what you think may be the top of the wave, or do you wait? A lot of variables. Number one, we have to think about where would they go next? Is there a reason for them to sell now where enough reason justifies selling? For many people, the answer is yes. Number 2, lifestyle, right? If they're going to pull out of the market and they want to get the best price so they can fund that next lifestyle, it's probably a good time to do that, especially when supply is so low and demand is so high. It's a basic economic question. Even with no economic course, you realize if you've got really high demand and really low supply, right, the sellers are probably going to get their price. And it's not about what the sellers are going to get for the house. The question is, what are buyers willing to pay? And many buyers are very bullish around the market as we know it today.
Great information. We have one last and final question. It's for you, Mike. Is there a tipping point? Can we have too much of a good thing?
Yes, you can have too much of a good thing. A tipping point actually is a point really where markets change characteristics. They go from a buyer's market suddenly to a seller's market or vice versa. There are periods like that. Normally you get, but let me just say this, there are no signs of that at this time. All right, as Walter showed, there's no excesses in this market. I see none at all. Normally, one of the signs of an ending or tipping point at the beginning of one, or when right before one, is when people are buying because they're afraid that if they don't, they're going to miss out. They don't buy because it financially makes sense. They buy a little bit out of fear that if they don't, they're going to miss out. That's normally the last leg of a point. We're not anywhere near something like that. So I think things look very, very solid here.
Great, thank you. Well, that ends our question and answer portion of the evening, or actually the morning. We'd like to thank all of our attendees for joining us and our speakers, Mike McDonald, Walter Neal, and Brady Sandahl. Thank you to our corporate sponsors, Sunrise Company, Toscana Country Club, Andalusia Country Club, Franklin Loan Center, Palm Springs Regional Association of Realtors, and California Desert Association of Realtors. Today's presentation will be sent out in a recap with the answers to questions that have been submitted today that were not answered. If you have any additional questions, please send them directly to me at my email, tally@palmspringslife, and we look forward to seeing you again at the next Market Watch. Thanks a lot, guys. You did a great job. Appreciate it. We'll see everyone in the fall.
Thank you.
Thank you.